From March 2000 to October 2002, the market dropped 45%. October 2007 to February 2009, it dropped 52%. And February 2020 to March 2020, in just a span of 1 month, it dropped 31%. These are just some of the market drops that have occurred in the last 2 decades. And this is without counting the ones that will happen in the future. Whether you're new to investing or a seasoned pro, having a strategy for uncertain times is essential. Let's break it down step by step. First, you need an emergency fund. This fund acts as a safety net during financial downturns, allowing you to weather the storm without having to liquidate your investments at a loss. And the formula is pretty simple. You will take your monthly expenses times the amount of month that you want the emergency fund to cover. It's recommended to save at least 3 to 6 months of expenses. If you want to save more than that for the peace of mind, you may also opt for that option. Pro tip, if you oversave, you could use that excess cash to buy equities at a discounted price. The next step is understanding the signs. The market and the economy doesn't often make drastic changes from one day to the other. Even though it's possible, it is highly unlikely. Keeping an eye on economic indicators like GDP growth, unemployment rates, geopolitical situations, and inflation trends can signal potential shifts in the market. However, it's important to not let negative news make you lose your focus. During uncertain times, it's wise to revisit your investment strategy. Consider adjusting your asset allocation based on your risk tolerance and financial goals. This might mean shifting towards more conservative investments or relocating assets to sectors that historically perform well during downturns. With that being said, we need to talk about diversifying your portfolio. Whether you go with a combination of bonds, CDs, stocks, and real estate, you need to be diversified. For the investor who fully focuses on investing in ETF or individual stocks, make sure you're well covered. Understand the ETF, their objective, and the diversification within. For individual stocks, the same thing applies. This is your own ETF. Make sure you are sector diversified and the fundamentals of each individual holding are strong enough to withstand economic meltdown. Worth mentioning that after a certain amount, stocks diversification become ineffective. Now, they say that investing is 80% psychology and 20% strategy, which means that it's very important to keep your emotions in check. It's easy to panic and make impulsive decisions during market volatility. Remember, investing is a long-term game. Stay disciplined and stick to your strategy. And to close it up, keep investing. Try your best to keep your contributions consistently even through bad economic times. This part is very crucial for your investing journey, as this is the time where you can buy high-quality investments at a cheaper price. That accumulation at discounted prices stack up, and when the economy recovers, those investments could return to the fair value and beyond, putting your investments in a position of capital gains. Preparing for a market downturn is all about foresight, diversification, and maintaining a resilient mindset. A company with the right strategy sets you up for financial victory. Make sure to revisit your plan from time to time, check up with your emotions before making any drastic decision, keep close to your circle of competence, and most importantly, stay invested.